Good day everyone and welcome to the premium video newsletter for August 1st, 2013. I can't believe August is finally here. Seems like the summer months just started and they're almost behind us. But on a brighter note, volatility is going to come our way real soon. Starting with the fundamentals, as usual, the numbers of Americans applying for unemployment benefits fell 19,000 last week to a seasonally adjusted 326,000, the fewest since January of 2008. The decline shows the job market continues to strengthen. Keep in mind that the Feds are looking at the job market as one of their factors in how they deal with the stimuli program. So these numbers have very strong influence specifically at this stage in the U.S. economy. The second report was from the Institute of Supply Management, which said its widely watched Purchasing Managers Index rose to 55.4 in July from 50.9 in June, expanding at its fastest rate since April of 2011 and well above market forecasts for a 52 reading. Both of these reports were bullish for the stock market, which rallied with momentum and volatility, something that's been lacking for a while, especially near the levels we have been at for the last few weeks. But today seems different and all sectors seem to be on board. The economic news was really bullish, so we have no disharmony between the different sectors today. Every sector is moving substantially higher. While volume is still very low, especially for a breakout to new highs, we do have to remember that it's summer, and August is the month when people try to take their last vacation before the year begins, especially in the US. I will say that for this type of momentum to continue to the upside, we have to see real good news ahead of us, more like what we saw earlier today. Several sectors are not at their all-time highs just yet. For example, take a look at this chart of XLF, the S&P financial sector. There's no extended range and the sector is clearly lagging. The financial sector is a large part of the index, and the fact that it's not joining the rally is bothering me a bit. But the financial sector is not a typical leader, but a follower, unlike the transports, which are screaming higher today. Further, the semiconductor sector, which has substantial influence on other technology sectors, is also lagging and not showing us any unusual volatility or trading range. The technology sector is usually the first one to rally during critical market turning points, but the earnings on chip makers and other technology stocks haven't been up to par this quarter, so this could explain why we're lagging in here as well. One market that's moving higher is the energy sector. The positive U.S. economic news is bullish for energy prices right now. In addition, China and Europe showed improvement in manufacturing, and we did break the 107 level as we anticipated we would. The next question is, will crude hit the high and finally hit the 110 level as we thought we would a few weeks back? The volume is adequate and the range is higher once again from yesterday. Both of these are bullish indications. The market can easily go higher from these levels. I see very little overhead resistance till we hit the old high, which is only a bit over half a buck away from where we are right now. I believe if the momentum in the U.S. stock market continues for at least another day or two, and I think it may, unless the fundamentals or tomorrow's morning earnings are terrible, we will more likely than not hit the 110 level, which was my original target a few weeks back. We will monitor it and we'll see what happens in the next 24 hours. Fridays are interesting because they are either really quiet or very volatile. You never get anything in between. We shall see very shortly. Turning to interest rates, and for those traders who don't trade futures and want to get into this market, you can trade the UST, which is the ETF that tracks the 10-year bond prices. Today looks like what yesterday should have looked like. Remember, this market is like a rubber band, meaning it can go back and forth without much of a trend. It overreacts, but today's news was actually meaningful because if the economy and unemployment improves, it'll directly affect this market. The next level is slightly below the 124.5 level. I will need to see some more bullish economic news from the Feds to believe that the break will be real. If tomorrow's employment news doesn't cause us to break the low, I doubt we will see anything till we have more guidance from the Feds, and that's not coming till the week after next. Expect range-bound trading and choppy range-bound action until we break the next price level. I wanted to look again at the Japanese yen from a purely technical perspective. Looks like the buying for now is over, and the next question is whether we will stop moving down at a higher price level. If you recall, I mentioned that my concern is not how high we go on this market, but whether or not we're going to break the low. And this is where we're at right now. I'm hoping the trend line will remain bullish and not go too much below the level we're at this point. Then we can hopefully begin building a base and some sort of support level that may hold for a while. But if we go much lower than where we're at right now, we will more likely than not break the low and continue moving lower. Remember, fundamentally and long term, the chart is still pointing to a bearish market. So this is why I'm being very careful with the yen right now. Lastly, the Aussie is still continuing its move down. And similarly to the characteristic, there's no increase of momentum or volatility. If tomorrow we don't erase this decline, I will begin taking the slide seriously. I'm not concerned with getting in early here. I'm concerned with getting whipsawed. So I'd rather lose a few bucks and end up winning in the long run. But I want to make sure this trend is for real. Never worry about getting in early. Worry about breaking your trading rules, and the rest will take care of itself. There's a few setups for tomorrow, and not surprisingly, they're all to the upside. The ratio of stocks moving up compared to down is once again out of whack, for lack of a better word. This is typical when we're breaking new highs in the stock market. There's a tail gap long on ADP, which is the biggest check processor in the country and is utilized by many small and medium businesses in the States. The second long is an inside day on ticker symbol ANDE, and the name of the company is Andersons, and the company specializes in the grain and fertilizer industry. The buy stop is 15 cents above today's high, and if filled, place a protective sell stop 20 cents below the low. The markets are volatile right now, so I want to give the trades just a hair more room to move. Next week, if the market does break out for real, we will have several trades using ATR stop losses, and I will go through that with you next week. Have a great night, everyone, and I will touch base with you tomorrow morning or earlier if something unexpected comes up.